very economically important, right? Not just for doing things using holdings, but also just in general, analyzing the attractiveness of different fund managers. Today, this is a very old slide. This is probably 15 years old. Today, we have in the US 8 trillion, double this amount, $8 trillion in equities managed by mutual funds. Most of that is about probably 65 to 70% of that is actively managed mutual funds. Okay, now that's not even taking account of pension funds, hedge funds, endowments, municipal funds, all sorts of other things. So it's a really important job that we get it right, because these active funds charge a lot of money, okay? It's not quite this much now, it's dropped, but probably the average dollar invested in an equity mutual fund today charges, actively managed equity mutual fund today charges about half this, about 0.5% per year. So 0.5% per year on $8 trillion is a lot of money. Okay, it's still in the tens of billions of dollars per year earned by the asset management industry. So there's a massive industry, and we need to understand whether these guys are truly earning their fees and for investors. Okay. I think this is especially important for countries outside the U.S. because most countries outside the U.S. the fees are much larger. There's less competition among active funds. So for you guys, I think it's even more important to understand if you are thinking of investing in Thai active funds or you are advising somebody in terms of whether they should invest in a Thai active fund. I think it's much more crucial for you to be good at this stuff than for me to be good at this stuff, because in a large sense in the US there's so much competition that I think that competition can eliminate kind of the weak players, but not so in places like Japan, in Europe, developed Europe, as well as China, Thailand, and so on. There's just a lot of room for improvement. So you guys, I'm counting on you to kind of be the leaders in the industry of the experts, the world's experts in terms of understanding how to benchmark these managers so that we can make them more efficient, okay? So there's a lot of real world implication to this class. Okay, besides that, actively managed investors trade a lot. Okay, they trade a lot more than index funds, and that costs money, okay? And that money is not trivial. That's again, you know, in the tens of billions of dollars that they're trading. They're costing us because they're trading securities on the SET or on the NYSE or wherever. That's very costly. Okay, so we need to know, is this worthwhile for investors? And I don't know if this particular controversy has been going on as much in Thailand and Asia as much as in the US, but in the US, there's a huge debate right now about active versus passive. Okay, has that debate been going on in a big way in the news in Thailand? People, no, okay, and it hasn't, yeah, so it seems to be focused in the US and in maybe to a lesser extent in Europe right now. But in the US, active funds have lost market share, okay, to some degree. It used to be that 90%, when I first started studying active mutual funds, about 90% of them were, when I first started mutual funds, about 90% of them were active funds, and only about 10%, see if I can make you trip over that, and only about 10% were passive funds. Now the world has changed, and it's changed pretty rapidly since the financial crisis. So that now about 60 to 70% of funds, not 90%, about 60 to 70% of funds are active, and the remainder are index funds, passive funds, okay? So the world is shifting pretty quickly now, and active funds are reducing their fees. Like I said, their fees aren't about 100 basis points, it's more like half this level. So there's a huge amount of controversy out there in the media, the financial media, and in the industry and in academia over whether active funds actually are worthwhile or not, or maybe they should completely disappear. Okay? So if you are, obviously if you are looking for, I understand you guys have to do a thesis for your degree. I mean, that would be one idea you might think of active versus passive management in Thailand or some other country as a reasonable thesis topic. And it could be focused on equity funds, it could be focused on bond funds, all sorts of things. It'd be a very interesting study, okay, and very economically relevant. Okay, so all of this stuff is appropriate for, I'm just going to skip through these slides here. These are all kind of, and all this stuff, by the way, is on the day 2, okay, on that website where you've got the laboratory exercises. There are slides, like day 1 slides, day 2 slides. So if you really want to look at all this stuff instead of reading the chapter, you can, feel free to download those PDFs and look at those like that. But it's all in the chapters too. And frankly, I think the chapters are clearer and easier to follow. Okay, so the thing about I like this cartoon because it sort of like represents a bunch of active managers. They all kind of look the same, from the outside. You can't really tell them apart. Especially if you look at their performance, their returns, because their returns are so similar, they're so highly correlated that they end up looking very much the same. So how can we tell them apart? We can try to use some really good benchmarking techniques and models, like the 4-factor model for U.S. equity funds, which you guys are implementing in the lab exercise number 2, or we can use a fixed income model, like a 5-factor from a French model, or we can use a 6-factor Elton and Gruber model, or for mixed portfolios, we can use an 8-factor model. So we can do a lot of that kind of stuff that we covered in chapter 3 to do a better job of reducing type 1 and type 2 error. But there are limits to what we can do because there's a lot of noise in returns in general for actively managed fund managers. Okay, so here's the thing: is that one of the major, let's see how long these slides get me here until I have to resort back to the chapter. So one of the things that can happen to a fund manager if you, or one of the problems that you can have with assessing a fund manager's performance if you used a fixed model like the 4-factor model. Let's just write the 4-factor model down. Okay, this is the 4-factor model, right? This is the one that you're implementing in the lab, in the Fin lab right now, against all those DFA funds, right? Okay, so you're running a regression. You're running a 4-factor regression, 1, 2, 3, 4, right, against your Y variable, right? And hopefully you're remembering to subtract T-bills, or you're going to get a bad result for the intercept, okay? So make sure you're doing that. But essentially you're running a simple 4-factor multivariate regression, right? Right? Okay. Okay. So what are the assumptions of this 4-factor model? Let's see if we can name some assumptions of this 4-factor model. Normally distributed residuals. Okay. So distributed normally. Okay. And also, these should also be normally distributed as well. Right? What other assumptions do we have besides normal distribution? What other assumptions can you see in that model? Well, one would be that these 4 are the only 4 important factors, right? So that could be a second assumption. Maybe we missed a factor, I don't know. But it seems that Fama and French and Jagdish and Titman and lots of people, Carhart did a lot of work to figure out that these are the correct 4 factors. And to be honest with you, several hundred papers on U.S. mutual fund performance and non-U.S. mutual fund performance have used this 4-factor model with great success. okay? So it's possible, but I don't think that that's a major problem in most cases for equity fund modeling. But there's some other assumptions built into this equation. Do you see any other assumptions here? Let me point to you to these guys. Do you see anything about those coefficients that might bother you or might make you realize that there's a big assumption embedded in this model? Okay, what is that? What is the subscript on those coefficients? P, portfolio P. Is there any time subscript? What does that say to you? Sorry? But it says also, okay, it says, it could say cross-sectional, but we're running this on a time series, though. We're running this on a time series because there is a T here and here. So this is a time series regression. Yeah, so it's not because it's a cross-sectional regression. It's a time series regression. But what does no T with the coefficients mean to you? What does it tell you? The assumption is that these are constant over time, right? For a given fund manager, this means that you're forcing the slopes, the exposures to each of these risk factors, okay, to stay constant for a given fund manager over time, over the entire time. So those DFA funds that you're running, you're doing the 910 fund, right, from February 1982 to what, 2002, something like that? Once you run this model, Excel says, I think you want to keep the coefficients constant for that 910 fund, okay? That's what it's doing by running OLS, okay? That means that it thinks that the beta, it tries to assume, or it does assume, that the beta for the 910 fund is constant over time, that the small cap exposure is constant, that the value growth exposure is constant, and that the momentum exposure is constant over time, right? That is a feature of an OLS regression model, okay? Now, we have to ask ourselves, is that realistic? Is it close enough? We know it's not perfect, right? We know that the beta of stocks shifts over time. The exposure of the portfolio to small versus larger cap stocks is somewhat constant with the 910 fund because they're trying to load up on micro caps in the 9th and 10th decile, right? From the little mini quiz from last time. That's their strategy. Okay, but it might vary somewhat over time. They might once in a while have some stocks that do well and go up into the 8th decile or the 7th decile by size. Do you remember from the case what they did when that happened? Did they immediately sell stocks when they went up into the 8th decile portfolio from the 9th? Okay, so the case said no, they don't just automatically sell those, they wait sometimes, okay, because they don't want to be a seller when it's not advantageous to be a seller, or else they're going to have to suffer liquidity loss as well. So sometimes they hang on to 8s for a while and then dispose of it when a good time to sell stocks comes up, okay, a strong market comes up. This means that their size exposure is going to vary somewhat over time, okay? Okay, again, probably not too bad for the 910 fund because they have this, you know, this defined strategy of staying close to or in the lowest 20% market cap stocks, the micro caps, okay? But you can imagine other fund managers might not be so consistent in their small minus big exposure. They might take on big caps sometimes, mid caps sometimes, and some small caps sometimes, right? Depending on the fund manager. Okay, so if that happens, then you're gonna get, then this is gonna be, so if this forces risk exposures to be time invariant. Okay? If assumption is badly incorrect, resulting alpha estimation is also going to be patently incorrect. Right? Right? If I have a fund that shifts betas or shifts some of these risk exposures over time, that means that the model is not going to properly estimate the alpha, okay? Because the alpha, the constant alpha assumption is based on the difference between the fund returns and the constant beta S sub P, H sub P, and U sub P assumption times these time series of returns. If these are not constant, then you know that this can't be right either, right? Because this is the difference between fund returns and risk exposure-based returns, okay? And there's some things that we can do with that. We can play around with the regression technique to do some conditional regressions and to do some pretty cute things that help to band-aid that problem. And sometimes we have to do that because only returns are available most of the time or much of the time. In Asia, portfolio holdings are not available that frequently, although I guess Morningstar is starting to collect more of them and maybe some of them on a monthly basis, so you're getting more and more information. Okay. In the US, we now have monthly holdings data for all US funds, with US mutual funds, which is exceptionally useful for this very problem here. Okay, so we can see what the fund manager is holding, and from that we can derive a time period by time period risk model instead of a time invariant risk model like this. We can do a time period by time period separate risk model. Okay, that's the whole point of portfolio holdings-based analysis, is we can do a just like think of this. If you have a manager who you think is sometimes holding high beta stocks and sometimes using low beta stocks, you can use the holdings, right? You could compute the beta of all the holdings, right? And you guys have done this before. Compute the beta of each holding in the mutual fund manager's portfolio, and then you could portfolio weight those to come up with that mutual fund manager's beta at any point in time t if you have the manager's holdings, right? Okay, so that would be similar to this approach, is that you let the beta vary depending on the weights and on the betas of the stocks in the portfolio. And then you make an adjustment like this, but on a time period by time period basis, not across all time periods like a regression does. Okay? Okay, so let's take a look a little deeper. So what types of things can happen? Okay, first of all, style drift can happen. So a manager may not be intending to do any kind of shifts in the portfolio risk loadings, but he or she may have a portfolio that just is moving around. Example would be the 910 fund. If the 910 fund managers are doing their job, then some of those stocks should move up into the 8th decile, right? Because that's a bigger decile. So if they're doing their job and they have a successful stock, it should move upward in size, right? In equity size, okay? And that's just going to be something that happens without them making any actions other than initially buying a stock and watching it go up in price. It's also possible that a stock can go down in price. And it's also possible that a stock can shift in terms of its characteristics. Okay? So here's the last thing first. An individual stock can shift characteristics over time from one year to the next, or even one quarter to the next. A value stock can become a core stock, and a core stock can become a growth stock, and a growth stock can become a core stock, and a core stock can become a value stock, okay? Depending on the price movements of the stock, depending on the earnings of the stock, okay? Consider, for example, Coca-Cola stock. Coke stock, you think, well, that's probably always been a value stock, and that's sort of what people think, but there are times when it has had really great growth in earnings, and really should be considered as a growth stock, not a value stock, okay? So this can happen, by itself. Even if the manager has just a buy and hold portfolio, for example, an index fund manager, sometimes we'll find that the index fund that he holds will shift in its style composition from being more core to more growth. Right now, the S&P 500 is more tilted toward growth companies than it was 10 years ago or 15 years ago, right? Because of the FANG stocks, right? The FANG stocks make up a huge part of the capitalization of the S&P 500, and they're all growth stocks, okay? So if you're an S&P 500 index fund manager, you now hold a growth portfolio, where before, 10 years ago, 15 years ago, you held a core portfolio, okay? But that means that we have to adjust this regression technique to measure a manager's alpha properly if something like that shift has happened, okay? If a manager holds a portfolio, and some of the stocks shift, we hope that it doesn't change the portfolio. So this effect up there can be diversified in a portfolio, is what this is trying to say. Okay, so let's say the manager holds some FANG stocks, Facebook, Apple, Google, Alphabet, etc., right? Netflix, right? Maybe that manager holds a good proportion of other stocks that shift from being growth to value. And then overall, maybe, we hope, that this diversifies away. So it might diversify away, but it doesn't always diversify away, okay? Okay, and then the third approach, or the third mechanism for a style shift in a portfolio is the managers sometimes actively shift their portfolio weights toward a certain type of style that's hot, okay? So this is a strong market force that investors and portfolio managers all wish to chase hot stocks and hot sectors, also called momentum investing, okay? So momentum's a huge influence in markets, okay, it turns out, among all types of investors. Both individual investors, dumb guys like me, and also professional investors like mutual fund managers and hedge fund managers. Momentum is a very strong force. Investors of all types like to chase winners, okay? And there are several behavioral reasons for that. They think that trends will continue, and to some extent they're right. To some extent trends do continue, okay? So let's take a look at a stock, for instance. Now consider a scoring system where at the middle of each year, June 30th of each year, consider a scoring system where I do, maybe I should go to the scoring system first. Let me see if I can find my scoring system here. Yeah, okay, consider a scoring system like this. Okay, so I take every stock in the NYSE, okay? I take every stock, consider a stock scoring system, okay? I take every stock in the NYSE, I rank by size. Okay, we did that in chapter 1, right? We did a sort on size and a sort on beta. Let's just do a sort on size this time, okay? Market cap of equity. And let's rank from high to low, where 5, and we assign 5 quintiles. We assign the number 5 to every stock in the large cap portfolio. 4 to the next largest cap quintile, 3 to the next, 2 to the next, and 1 will be assigned to all stocks that are in the smallest cap portfolio. As of June 30th of year 19XX or 20XX, okay? Okay, so each year we're going to do this. Each year a stock gets a size score. Is that clear? Is that clear? So 5 means the largest cap in the universe, okay? All right, secondly, we take each of these 5 size quintiles and we subdivide into value growth quintiles. So we take the 5, this is like the slicing test, okay? This is where you take here's large cap equals 5. Okay, second cap equals 4, 3, 2. Small cap equals 1. And then what I'm going to do is I'm going to subsort this into 5 sub-buckets, sub-portfolios. Okay? Among the large caps, I'm going to have high book to market, okay, equals 5, down to low book to market equals 1, right? Okay? And book to market, that's book equity divided by market equity. Book value of equity divided by market value of equity. And higher ratio means value stock. Okay? Is everybody comfortable with this ratio as a measure of value or growth? Because this is the ratio of the accountant valuation of the company divided by the market valuation of the company. If the accountants have a higher valuation for the company than the market does, then it says the market is underpricing this stock, too low. So that says you should buy that stock if you think the value, if you think the accountants are correct. Okay. In other words, this is a value stock. Okay. On the other hand, if this is small, then it means the accountants value the stock much less than the market. So you'll find that for the FANG stocks, right? They're growth stocks because the accountants haven't caught up with what the market thinks. And that could be because the market is smart and more forward-looking, or it could be because the market is dumb and is overvaluing all these FANG stocks. And which one is true? Who knows? We'll find out eventually, right? If the bubble bursts, if there is a bubble. Okay? Okay, so anyway, back to the story. We subdivide by value growth. So in portfolio 5.5, which is this one, in portfolio 5.5, we have large cap value stocks. Okay? In portfolio 1.5, we have small cap value stocks. In portfolio 1.1, we have small cap growth stocks. Okay, so it's kind of cool, right? A really simple way to characterize stocks, to categorize stocks into style buckets. Okay? And we want to do sorting and subsorting like this because same reason that we did that slicing test with beta and size, because if we just do sort on market cap and then independently sort on book to market, there's a correlation between book to market and size that will create a big problem. Okay? It turns out that small cap stocks have more value stocks in them than do large cap stocks. We want to break that correlation essentially, just like we did in the slicing test in chapter 1 between beta and market cap of equity. Okay? Now I can go a third step here. I can take each one of these. Let me blow this up with a magnifying glass. Okay? So I can take 5.5 and I can subdivide it into 5 different momentum portfolios. Okay? So these, be careful. Okay? So here's high momentum, second, third, fourth, low momentum. Okay? So we'll assign that a 5, 4, 3, 2, 1. Okay, so what was our definition of momentum on Sunday, on day 1? Does anybody remember? How do we define momentum in the stock market? Over what time period was momentum measured? 6 months to a year. Okay, so we got more people answering today. I think he was the only one answering on Sunday. Great, good. 6 months to 1 year past return is the momentum quality of a stock. the highest 6-month, and here we'll just do last 1 year, okay? Because that's what some of the literature does, okay? So we'll subsort each of these small segments here into 5 more, into high momentum to low momentum, based on their 1-year return prior to that June 30th of date 19XX or 20XX that year, okay? Okay, so now we have 3 things, okay? We have a triplet of numbers, okay? We have, for example, a 1 segment of stocks that has a 555 triplet, right? What kind of stocks are those? Large cap, high BTM, which is what kind of a stock? Value, large cap value, and high momentum stocks, okay? Okay? And if we have, let's say, we have a 1, let's say we have a 1-3-1 stock. What's that? Just to make sure we're all comfortable. Small cap, core value growth, neither value nor growth, core, small cap core, bad momentum, low momentum, negative returns over the past year. Okay, good. Good. Okay. That's all there is to this non-parametric ranking system. Core, C-O-R-E. Okay, that's all there is to this non-parametric this triplet of numbers. Okay, so we can divide by 5 times 5 times 5, 125 segments of stocks. Okay, and it ends up being a really powerful, so simple, but ends up being a pretty powerful way to designate what type of stock it is. And then if you portfolio weight the triplet, you can come up with a pretty precise way to characterize a fund portfolio at that same date, June 30th of 19XX or June 30th of 20XX, whatever it is, okay? Turns out this works really well, okay? And trust me, I mean, I helped invent this system, and many people have used this and stress tested it, and it ends up working pretty well, as simple as it is. No regression techniques, right? No regressions, just like a non-parametric set of slices, right? Okay? Then we can reassemble back into the mutual fund portfolio, the pension fund portfolio, whatever, and we can do this every single June 30th, right? We could do it every single June 30th of every year, 1997, 1998, 1999, 2001, 2. Every single year we could do this and come up with a different triplet for each stock and for each mutual fund, okay, holding those stocks, right? So this gets around that stationarity assumption of the risk metrics. The triplet can change every year at the fund level, and it takes into account changes in the stock because it just evolved into something different, changes in the portfolio weight because the price changed, and changes in the manager selection technique, okay? Because everything's based on the weights in the fund at each point in time. So it collects all those things together and corrects for all of them. Okay, so it's pretty cool. It's pretty cool. It's pretty easy too. So let's see how much, just for fun, here are a couple of graphics I think that are useful. How much, Exxon Mobil, one of the biggest stocks in America, okay, let's take a look at it back in 1985 in this triplet. So at June 30th of each year, I measured the triplet this way for Exxon. In other words, which of these 125 portfolios was Exxon a member of at June 30th of each of those years? And I wanted to see how this evolved over time, just to illustrate that even a big cap stock can change over time, okay? So what happened is, of course, Exxon never becomes anything but a giant stock, okay? Okay? But it does have some shift from core 3 to slightly value-oriented 4, and then back to core 3, okay? Now look on the momentum dimension. It goes from no momentum to low momentum to super high to somewhat high to super low. You can see it's all over the place here, right? So that indicates there's some massive problems with this assumption here, that nothing changes over time in a stock or a stock fund portfolio, okay? Okay, and this is Exxon. This is a blue chip stock that seems like it shouldn't shift over time, and it does in some important ways. It's easy to find other stocks that are smaller, that have more fluctuation in all three dimensions than Exxon does, okay? How about, and so I did this for a telecommunication pension fund. I think this is for the Verizon pension fund. This is the Verizon. I used to subscribe to Verizon. I just went to T-Mobile because Verizon charges so much money, and I got a big discount with T-Mobile. But anyway, Verizon has their employee pension fund. So at some point, I gathered the information on the portfolio holdings for this huge pension fund, multi-billion-dollar pension fund. And I was just curious how much over time the stocks in the pension fund shifted because of those three influences: evolution of the stocks, price shifts of the stocks, and active trades by the fund manager. And what I found, I think, was it didn't prove anything, but it was, I think, an interesting outcome that a massive pension fund where you think maybe all of these things diversify away from each other and that the style is relatively constant, I found some pretty surprising things. Okay, so I found some small shifts toward higher cap over this time period, okay? I found some shift toward growth, and in fact it was kind of breathtaking here at this point for a massive pension fund to go from 3.2 to 2.0 is a pretty big shift, right, in the type of stocks that they're holding. And I found that that this pension fund was also moving from a neutral momentum presence to somewhat of a strong momentum portfolio. And so why do you think that that pension fund was doing that?
Was it probably chasing performance prior to the bottom?
Yeah, that's what's going on. That's what's going on. Is exactly what's going on? Is this fund is chasing performance. And performance was in large cap, growth, and momentum. That was my conclusion exactly. Okay, this fund was probably chasing performance during the dot-com bubble. Okay, now I don't care what he was doing, but what I need to know is once I adjust for these shifts, what is the correct inference about alpha for this manager? If I assume that this manager just had the average of all these style metrics, if I assume this manager had a 4.8 and a 2.6 or 7 and a 3.4 or 5 over all the years, that would be a noisy assumption, right? I'm probably not going to get a very good estimation of alpha, because some years I've overestimated the style, other years I've underestimated the style in each dimension. So it's going to depend on how those over and underestimates do in the marketplace that year. Okay. Okay. So all this stuff just kind of points to the idea of needing, let me shift that here. Here's another one I thought was interesting just for fun, a university endowment. Okay, this particular university shifted from large cap to somewhat, for some reason they shifted away from large cap during this time period. I'm not quite sure why, but they definitely moved toward growth and they definitely moved toward momentum. So there's an indication that they were chasing, not that door. It's like a ghost behind that door all the time. So this indicates that university endowment was also chasing stocks, chasing winners during that time period of the internet bubble. So it turns out, interestingly, that this university endowment was the University of Chicago endowment. the guys who believe in efficient markets also seem to be chasing winning returns, which they're not supposed to do, right? Because they don't believe in that kind of stuff. So I thought that was pretty cute, pretty ironic that they were doing that too. Let's see. Let me move on. Okay, now I need to go back to the chapter. After that bit of fun. We just need it right. I think this works. Okay. Okay, let's see if I can find the tab. Or the other way, maybe just go like this. Let's go back to, that's right here. Okay, chapter 3, chapter 4. Okay, here we go. Do that. Okay. So let's start this chapter over again. Okay. I think I gave you some background here, some introduction, so we can probably go over this part of the chapter pretty quickly. So there are several reasons. So I think what is useful is there are several reasons why the use of portfolio holdings data may provide new insights into managed performance relative to returns-based methods. Okay, first of all, it helps us with the benchmark problem, the benchmark error problem. Okay, meaning that now we can be confident. Now we can be confident that if we assign a benchmark, now we can be confident that if our fund manager invests in small cap stocks, we're going to recognize that, okay? We're going to recognize that he's a small cap manager and not make a mistake of benchmarking him in a regression model against a S&P 500 or a value-weighted benchmark like we were trying to do in chapter 3. Okay? Does that make sense? Does it make sense? Okay. Secondly, and we just did this, okay? I'm just having fun coloring today. So style orientation of a fund might shift non-trivially during short time periods, such as a value manager who adds tech stocks during the 1990s. And we saw some evidence of that in maybe those couple of funds, the pension fund and the University of Chicago endowment, okay? In one of my papers, I never published it, unfortunately, but I found that some fund managers, active fund managers, do tend to move around on the style dimensions quite a bit in pursuing alpha, okay? Thirdly, something that we haven't mentioned yet, okay? If you look at holdings, then you might be able to figure out if the fund manager has stock picking skills before you deduct his fees and trading costs, because all I'm going to do here is I'm going to assemble his portfolio, and then I'm going to, for each of these stocks, I'm going to compute a theoretical return, okay? Using the close of the day, the close of the NYSE, from the end of one month to the end of the next month, I'm going to use the close of the NYSE tape prices, okay, plus any dividends paid to measure the rate of return of that stock, okay, for all of these stocks in all of these 125 portfolios, okay? So tape prices are theoretical prices, right? You don't necessarily get that when you trade these. So it doesn't include, so any computations that go back to using portfolio holdings and tape prices like we do in this literature do not capture the effect or the deduction of a fund manager of actual trading costs. So that's an advantage because it tells us before that manager has to trade these stocks, does that manager have good ideas? Okay, so we can start at that top line. Before trading costs, before fees, is this manager theoretically capable of choosing the best stocks out there, okay? Adjusting for these risk factors. Okay, and I'll show you a little bit more. It's coming how exactly I define the alpha of a stock relative to its dimensions, its risk dimensions. That's coming up in a second here, okay? So hang in there for that. Okay? Okay. Fourth, and certainly not trivially, okay, is this. When I look at holdings, I can figure out how did this manager make their money, okay? So that's a big deal for investors. I want to see, as an investor, I want to see, did this manager make money on all of her holdings, all of her trades, or was it just like one or two trades and holdings that this manager made 90% of her money, her alpha from? Wouldn't that make a difference to you? If the manager only was good at one stock and all the rest of the stocks provided no alpha? I think you'd want to know that, right? Because then you would be worried that maybe this is a one-trick pony manager, can only pick one stock. Or maybe that this manager just got super lucky. Okay? I'll show you an example of a manager that appears to be the case with in chapter 4. Okay? Let's see if I get to that tonight. I think I'll get to that tonight. Okay? All right, so we can see exactly where the alpha came from. We can do a stock level alpha and decompose a fund manager's alpha into stock by stock attribution of that alpha, which is really cool. This is how it's done in the industry when they measure performance. When a fund manager goes to a consultant and asks that consultant to do an assessment of his performance, they do it on a security by security basis like this. Okay? And this is called the Brinson, Hood, and Biedauer attribution approach, which is in chapter 12 of the textbook. Okay? And kind of related to that last point is that when you see whether a fund manager performs well among a lot of his stock picks or only among a few of his stock picks, it tells you something statistically about the manager's capability or skill. If the manager demonstrates skill among a lot of his stocks, then this indicates this manager is a very consistently skilled manager, and that it's not likely that this manager is generating alpha at the fund level by luck alone. If this manager only has one or two stocks that deliver all of the alpha, it's much less likely that this is a skilled manager. This is, more likely a manager who has gotten incredibly lucky by holding an Apple stock or something like that has just taken off. Okay? We don't know for sure. This is all statistical, but that's kind of the best we can do without actually talking to the manager and asking him, before he invested in Apple, why are you investing so much in Apple? What do you expect to happen? And what do you expect to happen to your other stocks? This is the best we can do if we can't talk to the manager and glean some more information about the strategy from that manager. Okay, so let's start from kind of basics here in terms of how all this portfolio-based performance analysis is done. Now that I've kind of illustrated it to you, let's start from basics again to build up some metrics. Okay, the first thing that we wish to recognize is that the skill of a manager in choosing a stock at time t-1 can be measured by the covariance, the skill of a manager in choosing a particular stock at time t-1. So WT-1 is the weight that the manager puts on the stock at the end of time t-1. You can think of that as the end of January, okay? So the skill of the manager in picking a stock at the end of January can be described as the covariance of the weight of that stock at the end of January and its rate of return during February. Right? That seems to make sense, right? Okay, you can do this as a correlation coefficient too. You do correlation between WT minus 1 and RT, but there are some advantages to doing covariance. It's easier to work with, as you'll see, okay? And we can always scale it back to become a correlation coefficient if we want to. But this is sort of what the literature has done. This is the road that the path that the literature has taken, is to look at covariance-based measures. There are a lot of reasons for that. I won't go into that now, but there's a whole literature that sort of supports that way of thinking of it, performance. Okay? All right, so does everybody understand this? This is just like, seems to make sense, okay? A seem to make sense equation. It's a portfolio holding measure of performance or skill equals a covariance between a weight and a future return. Make sense? Make sense? Okay. Okay, so if you buy into that, then I can go the next step here. Okay, so covariance can be measured a few different ways. All right, if I don't know, remember if you paid attention to this in your stats class. I didn't really pay attention to this in my stats class until I started working in this area, and then I realized I really missed something in my stats class by overlooking that. So there are a few different ways that you can write covariance. Okay, let me do it in the same order as is done in the textbook so I don't confuse you. The first way is that I can multiply, let me get this down first before I talk. And then I guess I have 3 braces on the right side here. Okay, the first way that I can write covariance theoretically is the expected weight times the deviation of the return from its mean. The second way I can write it, I can expand it. Is that good mark go? Here it is. Second way I can expand it is by demeaning the weight and multiplying by the return. So I can demean the return, I can demean the weight, or I can demean both of these things. Okay? All these 3 are equivalent, okay? Now, so if you don't believe that, you should go back and expand all these out and prove to yourself that these all are the same thing. They definitely are, okay? Go back and derive that yourself if you're not comfortable with that, okay? Those 3 expansions, those 3 ways of writing covariance are exactly equivalent to each other except for their form, except for their structure. They all expand out to the same exact thing. Okay, which is pretty cool. I mean, this gives us 3 approaches to computing a theoretical covariance, and this is used in this literature. Okay, these are up here if you can't see it from what I'm writing. This is equation 4.1. Sorry. Okay. Okay, so yeah, I thought when I took stats that these were just mathematical technicalities, and I didn't really pay too much attention to them. Okay, and maybe it was my instructor's fault. I don't know, but. I didn't really appreciate it until we started working on this literature. So it turns out that each of these 3 can be used as a different type of performance evaluation measure for portfolio holdings-based performance based on the fact that each of these 3, they're equivalent. So the key thing is that these are equivalent, exactly equivalent, asymptotically but only approximately equivalent in small samples. Okay? Asymptotically would be to have an infinite number of observations. You can actually do the theoretical expectation of something, but when I do a small sample estimation of each of these three, I'm going to have to rely on a particular sample to come up with the estimation. Okay, so here's one way to do this, okay? So let's say, first of all, let's start with saying that I have, okay, remember I said covariance of the weight with the future return is a way to measure the skill of the manager in picking that stock, okay? So now let me sum that over n stocks. The manager holds n stocks, so all I'm going to do is sum that covariance, okay? Okay, so again, one more time. So I argued that the covariance of the weight with the future return is a metric of the skill of that manager in picking that stock. Let me now argue that the sum of all those over the capital N stocks chosen by the manager is a total measure of skill of that manager. Okay? That's all I'm saying here. Now, in a small sample, I don't know what the expectation, so I have to take the sample expectation of this. And so let's forget about this for a minute. The sample expectation of WT minus 1 times RJT minus expected RJT is equal to this, right? That's a sample mean, right? Okay, well I still have to worry about this, okay? This is not, nobody gives us this thing either, so I gotta worry about it. But let's leave that alone for a minute or two, okay? Because there are several ways we could estimate this too, okay? So this would be the small sample approximation for the first expansion of covariance right here. Does everybody get that? Right? 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 1 over t times the sum of t observations of the product of these two things, right? Okay? The second estimation, this one in small sample, here's the large sample. In a small sample, I have to estimate this way. So here's the small sample estimate of the second expansion of covariance. And then I could do, I have the third one too. And then I could do one more, I guess I didn't write it down here. I could do one more that would be, I could do one that is the small sample expansion of the third approach too. And this would just be right? 1 over t, right? In a similar way, I could do the small sample estimation of this large sample covariance operator, okay? By demeaning both of these two, okay? So you can do any of those three, but in a small sample, they're only approximately equal to each other. And actually, in performance assessment, they have very different advantages and disadvantages from each other, and different economic interpretations, which is pretty cool, okay? So let's go back to the first one, okay? This guy here, which is at the, where should I start this guy, I guess? Is here, okay? So, Grinbot and Tickman, which I label GT, okay? These two guys were my advisors when I was a doctoral student, so I know they work pretty well. These guys basically said, this is the way to do it. This is the way to estimate the covariance in small samples, is to use the weight minus the expected weight times return, sum that over all the time periods, okay, divide by T. So that's the covariance for one stock, and then I'll sum that up over all the stocks held in the portfolio. Okay? And I can rearrange this any way I want to, like this, doesn't matter, it still means the same thing, okay? But once you rearrange this, so once I flip the order of the T and the N, you see it was N times 1 over T times sum over T. Now I do 1 over T times sum of T times sum of N. That's okay, that's doable, that's okay algebra. Tricky, but it's okay, okay? The nice thing about this is that this is the weight of a stock, of stock J in the portfolio, minus some benchmark weight, okay, times the next period return, and then this is just a summing across all the stocks in the portfolio. So it basically says the way to compute the GT measure of covariance-based alpha is to sum up across all stocks in the manager's portfolio the actual weight minus some benchmark weight times the following month's return. Does that make sense? Okay? And then what I can do is, so I've done that for one time period, and then what I can do is I can average that over all time periods to come up with the overall average skill of that manager in choosing stocks. Okay? On the other hand, Copeland and Mayer said earlier in 1982, they said, we like this way of doing the decomposition, which is to take and d-mean the return on each stock and multiply weights times d-mean returns. And we know in large sample, it doesn't matter which way you do it. Copeland and Mayer did it this way to do a study of, I think it was value line investment recommendations back in 1982. Okay? But so it can be done either way. It's just that in practice, there are some advantages to the GT measure over the CM measure that I think are non-trivial, okay? So, and this comes in, how do we come up with this guy here, the expected return, and how do we come up with the expected weight? Because I haven't defined that yet. We need a proxy for expected return, and we need a proxy for expected weight in a small sample still. I haven't solved that problem for you yet, okay? Okay, so there are a lot of ways you could do, let's think about expected return. There are a lot of ways that you could do an expected return on a stock. You could measure the average return of that stock over the last 10 years from Bloomberg. You could fit it to a CAPM and measure the average rate of return based on current market conditions and the beta and so on. Or you could go in the future and see what its future returns are and average those, but we don't want to do that because we want to assess the manager's portfolio today. We don't want to wait for 10 years until we can see what the future returns are. So in essence, this means that we're going to have to choose a past return, a set of past returns, either 10 years worth of past returns and average them to come up with this, or what Copeland and Mayer do is they just say, just pick a single rate of return for that stock that is like 1 year old, okay? So if this is January of year 2018, make this the return in January of 2017. Okay, it's a noisy proxy, okay? But the idea that Copeland and Mayer have is if you do this for a lot of stocks and a lot of time periods, the noise in that proxy should wash away. Okay, so there's a lot of stuff, I don't want to really go into depth into that, but there's a lot of stuff behind that, and there are a lot of tests that they do to show this, and if you're interested, you can go back to the Copeland Mayer's 1982 paper to see it. But this is one way. Basically, the idea here is that you need to use past returns data to estimate that expected return. Okay. Now, the problem with using past returns data is that if I take the January return okay, January 2018 return, and subtract the January 2017 return, okay, in some sense that measures the momentum of a stock, right? January 2018 return minus January 2017 return, it's like a 1 month over a 1 year, 1 month return measured 1 year difference, but it's kind of like a momentum. It's got a bit of a momentum flavor to it. So the problem with this metric is if the manager increases weights increases weights today based on the fact that the stock has had momentum, then that's not going to be a very good metric for performance. It's going to be biased toward finding performance for momentum investors, okay? And for that reason, all this stuff is in the book. If it's not coming clear to you, I just want to try to break the ice for you a little bit. You can read all this in this chapter. But GT say, no, the way to do this is not to use past returns, it's to use past weights, okay? Do the second covariance estimation technique, use past weights, okay? Past weights can't really be a biased estimate of expected weight, because past weights are past weights. You can't really, there's really no correlation between past weights and current weights. Okay, as long as you be careful about price changes in these weights, okay, so, passive price changes. But basically, Grindlatt-Tittman say this is a better approach to use, and in fact, this has superior intuition, okay, because all you're doing is, let me see if I get to the point where, so Grindlatt-Tittman say, let's use this. So here's where I've substituted in for one time period. Here's where I've substituted in the proxy for expected weight for one time period. I got rid of the 1 over t times summation over t because I'm just focusing on one time period here, okay, to make a point. The point I'm making here is that this GT measure can be interpreted as the sum of the weights times the future return minus the sum of the weights of a year ago times the future return. You see that? So the GT measure can be interpreted as the sum of the weights today, the sum of the weights at the end of January times the February rate of return, minus the sum of the weights 1 year ago times the February returns of this year. So what does that mean? That means that the GT measure is the difference in performance between the portfolio that the manager actually held at January end versus the portfolio that the manager held 1 year earlier at January end. The idea here is that this weight change is like a trading measure. If he traded into a larger weight for stocks that have higher returns next month, then this guy should be awarded with an alpha, okay, for that movement. If, on the other hand, if he increases weights for stocks that have a negative return, he should be penalized. It's got this really nice intuitive feeling that the way to benchmark a manager using portfolio weights is look at how his current portfolio is doing, compare it to one of his old portfolios if he had held it today. Okay, really powerful concept, and one that practitioners really like that idea, is if you're skilled, you should be moving in the right direction relative to where you used to be. And if you're not most of the time, then you probably have no skill. Okay, so this can be kind of thought of as a trade-based metric of performance assessment using portfolio holdings. Okay? And then you can average that over time, okay? Again, to get the time series average of the trade-based performance metrics. So let's see if we can take a quick look at an example here, okay? So what I did here is I took an actual, you remember our friend Scott Schozel on I guess it was on Tuesday at the beginning of chapter 3, the guy who held a concentrated portfolio and was a .com manager. I decided I'm going to put this guy to the test. So what I did in table 4.2 of the chapter is I built up his GT measure. So you can see from this exactly how this is done. If the formulas confuse you, look at the example, okay? And so what do you find? So let's see. So first of all, here's what he held. These are actual numbers. These are actual shares that he held at March of 1997, which is right here. What I call Ben shares, that's the benchmark period, which is March 31st, 1997. And here's what he held at March 31st, 1998, what I call the current shares, okay? So what happened? He increased his holdings of Microsoft. He sold 2.3 million shares of Coke. He tripled his holdings of GE, dumped IBM, dumped PepsiCo because he didn't like Coke or Pepsi, as it turns out, and doubled his Pharmacia, dumped Boeing, blah, 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 all the way through United Airlines, all the way down through this. And there's more on the next page. And I think what is most interesting is this right here. Okay, if you stare at this 2 pages long enough, you see that this is the one that sticks out. Is he went massively into Dell during that year. He held 0 shares at the end of March of 97, and he held 4 million shares, each valued at each valued at $135. That's a massive investment, right? That's $500 million. That's $500 million plus in Dell that he invested in 3 months, okay? Obviously a huge bet. And so let's go back to the headings here. And so I computed the benchmark weight and the current weight of each stock. And you know, there's some like Microsoft, he held 3.94, and he doubled this, almost doubled it to 6.3%. So his change in portfolio weight was 2.36% on Microsoft. But let's take a look at Dell. Look what he did here. Again, if you stare at this table like I did for a while, this starts to really stick out, okay? He increased his portfolio weight on Dell from 0 to 9% of his portfolio, 9%. $500 million, okay, he stuck into Dell. I mean, that's a pretty gutsy call, right? That's a big bet, okay? And you'll find none of the others. Well, he's got Schlumberger, he makes a big shift too. He's not a shy guy. He makes some massive bets. And this is what I found about this guy is he really had a ton of self-confidence in his ability. So he made massive bet. Warner Lambert from 0 to 5%. He made some colossal Lucent Technologies. Remember those guys? He went from 0 to 7% of his portfolio. So there's another major bet. This guy is making major bets over not a 3-month period, a 1-year period. He's making major transitions of his portfolio, and as you can see, a lot of it's going toward new economy stocks. And they're online, 2%, 3%. And you saw Dell already. Coke, what did he do? I guess I got that wrong. Coke, I guess he went from 0 to a holding in Coke. How did I get that wrong? Anyway, but you saw a lot of his portfolio started moving heavily toward telecom and .com stocks, okay, and computer hardware stocks and stuff like that, okay. So this is how you do the first part of this portfolio weight metric. Is the first thing you have to do is you have to compute the weight, and then you have to compute the weight a year ago. And that's exactly what I've done here. The weight a year ago, subtract the 2, and you get the delta weight. Okay. The next thing you have to do is multiply by the rate of return on the stock. Sorry, it's really bright. Sorry. Sorry. I was just trying it out. Okay. Okay. So this is the first step. Table 4.1 is the first step. Okay. Now let's take this to table 4.2. Here's the delta weight that I computed in table 4.1. Now what I can do is I can multiply it by the rate of return over the next month, which is this one, so this is the April rate of return for each of the stocks. This is the May rate of return for each of the stocks. This is the June rate of return for each of the stocks, okay? Okay? All I have to do now is take the delta weight times the April return to come up with this thing here for April, okay? For a particular stock. Then I sum that all the way down that column, right? I sum, so it's this times this equals this, okay? Again, this times this equals this. Sum this whole column, and I come up with what the total sum of his portfolio trade or shifts were from 97 to 98. Make sense? For April. Okay, so that's his alpha for April 1998. Okay, next column is May. Here what I do is take the delta weight. I only have a delta weight. I'm only taking 1 year delta weight. I'm not updating it. So this is going to take the delta weight from March to March, multiply it by May now to come up with this number. Sum these all the way down. This will be his May alpha, okay, of his 1 year shift in weight. Does it make sense? So that's his trade-based alpha for May. Return 3 times delta weight ends up in change return 3 column, okay? That's his June alpha from the shift that he made from March 31st, 1997 to March 31st, 1998. Does that make sense? Okay, so again, if you can't understand the formulas, if you're having trouble, go to this table and see if you can understand each column in that table, and then I think the formulas will make a lot of sense to you. Okay, so but let's take a look. We're about to the point where we should break, but let's take one last thing here, and then we'll break. Let's take a look at these change returns, okay? So the change returns tell me the contribution of each trade to his overall alpha. So let's see if we see some big ones here, okay? PepsiCo in April provided 0.44% of this guy's alpha. So that's pretty big. What? Which one? Wells Fargo? Yeah, he lost 1% alpha in April from Wells Fargo trade. So he made a big mistake there. They lost 1%. You can look through here. What are the big ones and the big negative ones? I'm not seeing much of anything yet. Here, Danka Business, 0.73. Not too much. Just keep going. Gucci, didn't make anything on Gucci. Gucci. Let's keep looking. All right. Oh, here's one big one. Dell. Okay, so he made 1.13% of his alpha on his entire portfolio from Dell. Okay, so that was a real hot pick for him. Okay, so he did so well on Dell that it improved his entire portfolio of wealth by 1.13% in 1 month alone. That was June. Look through this some more. This is incredibly powerful though, right? You can see like stock by stock, where did this guy achieve his alpha from? Okay? In the trades that he made. Okay. And what was this thing here? What's going on here? Okay. Okay? And so the sum down, any of those columns, change return 1, change return 2, change return 3, the sum of those numbers would be the GT performance in April or May or June, the alphas. Okay, we can think of those as alphas because those are shifts in weights. The assumption here is that the benchmark weight, okay, the assumption here is that the benchmark portfolio had the same beta, size, book to market, momentum as the current portfolio does. That's the assumption you have to buy into. Okay? So that assumption is not exactly correct. because this guy might have been shifting from value to growth and all that kind of stuff. So there's still gonna be a minor problem here that we have to deal with, but we'll wait until, tomorrow to deal with that one, okay? Okay, so why don't we take, a break here?